Joining us now is Jason Schenker, President and Chief Economist at Prestige Economics. Jason, thanks so much for joining us today. And as we're seeing in the early going in trade in Asia this Monday morning, markets really shrugging off those spectacular events in Venezuela. How's your risk appetite this morning? Any change?
Well, not really. This is something that is part of, I think, the geopolitical tensions I've seen rising over the last few years. Cold War II is a book that I had out, international bestseller early last year, talked about these risks, talked about including Venezuela as a potential source of proxy war risk in Latin America because of its closeness to Beijing and Moscow. And that, I think, is one of the key factors here. If you look, a lot of what's going on is just a continuation from the U.S. national security strategy and the Trump corollary to the Monroe Doctrine, as well as the other accelerations and tensions we've seen globally in just the last couple of weeks following the National Defense Authorization Act, with funding allocated for aid to Taiwan, as well as for a military drill, a large-scale drill based on mobilization assessment and sustainability for U.S. action in the Indo-Pacific region, and then follow that by Chinese military actions, the Justice Mission 2025, in which joint forces surrounded Taiwan, including the Chinese Coast Guard, as a temporary blockade, right? This kind of action is something that we see, the Venezuela story, part of rooting out the influences of Moscow and Beijing in the Western Hemisphere. Those tensions are likely to persist on a global basis.
Yeah, and if we zoom out from all of this and set aside all the drama, the fundamentals remain the same. I mean, we have a chart here on the Bloomberg terminal which illustrates, oil prices with that market in oversupply and approaching a glut, and at the same time, gold just dramatically outperforming it. Is this a trend you see continuing throughout this year?
Gold prices, precious metals in general, do see significant upside risk because global geopolitical tensions show no sign of easing. We see a risk of an acceleration going forward. As for things like oil, there is upside for oil prices later in the year because there's upside potential for global growth with lower interest rates globally, in addition to the weaker dollar. I'm forecasting a somewhat weakness through the first half of the year in the greenback based on expectations of further Fed cuts, but then there could be some bounce back in the dollar in the second half of the year as growth improves further and the U.S. labor market sees some upside. What all of that means is that industrial metals demand could see upside in the second half of the year, but could also rise in the first half as well. The growth prospects globally are increasing and improving, and of course, while we don't want to think about moving to military readiness and economic mobilization for wartime readiness as a means of conflict deterrence, we see it in the United States, in Japan, in Europe. There's increases in defense spending, which will support growth, but will also impact currency markets and will drive up demand for industrial metals. All of those trends seem likely to continue in 2026, especially because there is widespread awareness and belief that 2027 is the year that Premier Xi has said he wants China to be ready to be able to take control of Taiwan. Well, 2027 is less than a year away now, and if the United States and other countries, including Japan, Australia, and other allies, want to deter that kind of conflict, they have to project readiness. And I think a lot of what happened in Venezuela was a demonstration of power, also to be seen through the eyes of Moscow and Beijing and their would-be allies, in the same way that the bombing of Iranian nuclear facilities by the United States was also done for Beijing and Moscow to see it and to be aware of what the risks are in the event of a larger conflict over, say, Taiwan.
To your point about some of the beneficiaries from U.S. policy, it sounds like defense could be one of the sectors. You also look at how IT or AI-related industries have performed in the past year. What is that going to mean for the U.S. economy for this year, and how uneven do you think the growth is going to look like?
I think there's going to be more opportunities in AI and technology. I think the technological iron curtain between the United States and its allies and China and its allies, that's going to fall more fully this year. You're going to see dual-use technology supply chains further cleave. You will see those bifurcations. I think that supply chain is going to become more critical. I think industrial production, heavy industry, manufacturing, material, dual-use technology, all of those are going to be sectors for big opportunities in the year ahead. And of course, if you realize that global supply chains are splitting and there is a preparation for a risk of economic amputation of China from the global economy, the way that happened to Russia when it invaded Ukraine, that risk is going to drive investments in supply chains so that manufacturers and businesses are secure, even in the event of full economic amputation from China.
You're alluding to some of this, perhaps rethink that has already been underway last year, the continuation you speak of on U.S. assets. What is your sense of how that unfolds for the dollar, especially against the backdrop of a yuan that has been resurging?
I think that for the dollar, there's been significant downside this year, which has been a benefit to the U.S. That is a detriment to China. A weaker currency and lower interest rates favor a country trying to wean itself off of Chinese imports. And so that weaker dollar we've seen throughout the past year, we can see a little further weakness. Those are things that disadvantage Chinese exports into the United States, and those are things that advantage American domestic manufacturing. So I think you're going to see a little bit more dollar weakness here. The People's Bank of China may take action this year to try to weaken their currency. We'll see how that goes. But there are risks to Chinese exports and the Chinese economy if we continue to see that pressure, and if we see pressure rising from Europe as well, where we now see a lot of goods that would have otherwise come to the U.S. going into Europe. You're going to see some pushback there as well, because we're in Cold War II, and the collaboration between China and Russia and their allies is so strong, and Europe is probably going to push back on that as well. We're probably going to see those pressures result in further a redirection of investment and production. We could see China remain a very risky place for Americans to invest and for others. And it may be that Americans view China increasingly as a great place to send your money if you never want to see it again, because that's what happened when Russia invaded Ukraine. Those risks could increase.
Jason, I just want to finish with a bit of a bread and butter question, really. We've got a Fed meeting coming up later this month. I mean, the bond market's pretty much shaken off the events in Venezuela over the weekend. Seems to be looking ahead to the ADP jobs numbers we get later this week. What are your expectations around job market strength or otherwise in the U.S., and what do you think we'll see this year in terms of Fed easing?
I think we're going to see 2 Fed rate cuts this year. Last year I expected 3, and that was out of consensus. We got 3. This year I expect 2. I know that's a little out of consensus as well. Most are expecting 1. I think we're probably going to get our first one in March. I don't expect a rate cut here in January. For the next jobs report and CPI report, I think the CPI, both year-on-year and core CPI, are going to bounce back a little bit, jump up to 2.9% year-on-year from the lower numbers we saw in the November report. For December jobs report, I think the unemployment rate is going to come down to 4.5% from 4.6. Payrolls be modestly positive. For the full year, I think the unemployment rate will be higher than last year, and I think the total CPI and core CPI will be average this year, lower than in 2025, allowing the Fed to cut twice.
Jason, thank you very much for giving us this food for thought for the year ahead. Jason Schenker is President and Chief Economist at Prestige Economics.